Divergence. When considering the 5 technical analysis we need for every trade setup, first being trend, which is made up of higher highs, the same time making higher lows, giving us an uptrend. In consideration of the MACD divergence, it is not a trend indicator. It is more a momentum indicator. So let's review the MACD divergence. First, we see that there's a histogram divergence, calculating the move inside the histogram. Also, you have a MACD divergence crossover lines. You see in a lot of scenarios, these will double at the same place. And of course, you can use the understudy or you can use the upper study on the candlesticks, one or the other, just by turning it off. For these examples moving forward, I'm going to take off the lower study. Remember what we said about trend. When you have higher highs and higher lows, that confirms you're in an uptrend. And this is where you have to match the uptrend with the divergence to get the best results. Using the Elliott Wave, let me show you where the divergence will show up. Typically, the histogram is smaller in length, and so it will show up on the resistance side of the Elliott Wave, indicating the momentum is going to go lower. The MACD crossover lines might show up a little bit bigger, encompassing 2 highs, either here or here, showing you a bigger reversal pattern. Or you could either have the MACD crossover lines show up in the same exact place as the histogram. For bullish histogram divergence, they'll show up here. You might get the 2-line crossover divergence also here, and they could be bigger in nature, giving you this divergence here, giving you great places to enter into the trade. Understanding the momentum of the overall trend, in this case going up, obviously a divergent signal here is going to have less of a movement down and not guarantee that it'll come all the way down to the bottom than a bullish divergence here with the trend, yielding the biggest moves. Trend is up, and we can see the bigger moves with the divergence that goes with the trend than the smaller moves having a countertrend trade. Trend's going up, and you have 2 very large moves. Counter trend divergence going down, not very big, making lower highs and lower lows. We can see there are a couple good moves counter trend trade, but then there's also another that didn't work. Remember, the trend is your friend until the end. Once price broke above this resistance level, old resistance becomes new support. No wonder we had a divergence there. Perfect place to enter a trade long. Nice run up into new resistance. And then again, high, lower high, lower high, lower high, making a downtrend. We need to match the momentum with the trend, so we already know that these divergence alerts will be no good. Price breaks out, old resistance becomes new support, divergence in the perfect place with a huge up run. Low, higher low, giving you an uptrend. We get that alert, but we don't take it. We wait for the higher probability with the impulse wave up. High, lower high, lower high. We know we're in a downtrend, giving us a great divergence signal to take the trade lower. We see it, but we don't want it. Making lower highs, downtrend. We only get 1 alert, and it does amazing. We broke out of our downtrend. We're only taking up trades. 1, 2, it's perfect. Trend and momentum matter. Trend, making higher highs, not a good alert, not a good alert. Decent alert if you had a trailing stop, but here's another thought. Once you're at the highs of a trend, why risk it taking these trades? Break the trend, old support becomes new resistance, take the trade lower. How much lower? It's a doozy. That would have made a lot of money. You're making lower highs, you get another alert, enter into the trade, and make huge profits. And remember this trade here, I said, why should you get into it? 1 great trade, 2 great trades. Should you get into this trade? We're talking about trend and momentum. Well, looking at the typical Elliott Wave, your first divergence and your second divergence will be the biggest increase, giving you the largest percentage profit. And your last divergence, you're at a risk of having a counter trend trade coming up into resistance, getting ready to change the trend. So that might be something for you to consider, only getting into the first 2 alerts on any new trend form. There's lots of trades out there. You don't have to chase every one, even though this worked out beautifully. Nice reversal at support, old resistance, price broke out, so we know we're having a trend reversal, and you get a divergence signal long. Great profits. Divergence and support and resistance. So I've said it a lot about old resistance becoming new support, or the divergent signals are coming in at lower lows or lower highs, helping you be able to build your trend lines, kind of like here and here. It'd be easy to say, that's a resistance. You have another divergence showing up, draw your trend line across saying that's resistance. Understanding that the divergence will typically come at points of momentum shifts, and when you have a momentum shift, it makes up the body of the trend. Can't hammer this home enough. The divergence is a momentum indicator of what's happening in the overall trend. Now looking at time and price movement. There's a couple ways to measure it. If you get a signal here, considering this to be a flagpole, You might want to duplicate this flagpole, putting it at your entry, calculating the days in movement of your target. If you were to see the divergence up here, you could do the same thing, calculating from your entry point, duplicating the last impulse wave for your target of time and price, giving you a good expiration and price target. Another way to calculate is by taking the highs and lows, making a range box, and duplicating that range box up on top of the breakout, giving you a great place for targets. In a case like this, you have the highs to lows, measure down, duplicate that range box up. So we can see that the price came right into that resistance zone before consolidating and selling off. The time took 2 months, and we can see that was plenty of time for this option. Looking at this entry here, we can take the flagpole from back here, duplicate it over to our entry point. We did come up a little bit short from our exact target. Overall, the results were good, and that's why I like to add an extra month to my options, just giving me that buffer. Overall uptrend, trend continuation divergence. If you were to range box right here, price came right back up into those old highs, but didn't go anywhere else. Always best to have a stop loss or consider a trailing stop from this entry point here. Consider a flagpole, duplicate that over to your entry, and you can see it almost worked out perfectly. But if you added a month, it definitely would have worked out. Downtrending stock, get the divergence, enter into the trade with the trend, and if you see you come into support, take your profits. Or range box duplication, also showing you the support level. Downtrend, divergence alert, right to the lower support level, measure the last move, duplicate that over, and you would have seen that you didn't make quite all the money that was potentially there. And that's okay. It's going to happen sometimes. You get out early. Better to have a lot of wins than the hopes of big moves. Downtrend reversal, breaking out, making higher highs, take the alert, measure from the last low to the last high, start at your entry, time and price both worked out perfect for a target. Following these steps will really help your divergence trading.